Hey, what's up YouTube? It's Sam with the Home Outliers. Hope you're all having an awesome day and staying safe out there. Today's video is on a mortgage REIT stock that is up 481% in the past week. Just absolutely crazy. If you're able to get in this stock earlier, it was a stock usually hovering around $7 to $8 and dropped all the way down to 32 cents along with the market crash. Let's dig into the stock to see if it's too late or can you still double up or even triple your money in this stock. But before we start, please smash that like button down below and subscribe if you haven't already. It's always hard for the little guys, so any support you can show, I greatly appreciate it. And a quick disclaimer, please remember to do your own research when picking stocks. I am not a financial advisor, and this is meant for entertainment purposes only. Alright guys, so the stock market has been absolutely crazy lately, with some stocks making some crazy moves while others haven't. They've been lagging behind. You can see here from my M1 Finance portfolio, I started investing in this since December of 19, and my market portfolio is down 32%. I recently created another pie for airlines just because of how much has gone down and they pay good dividends. So you can see here that all my sectors are down except for airlines. I've been buying into that slowly. So this is what I use to diversify when I'm not picking stocks as a whole, buying them. It's just a great way to buy expensive stocks such as Amazon or Google at fractional portions, and it's a good way just to diversify overall. But let's go ahead and look into the stock that we're talking about. So the stock we're talking about today is MFA Financial, ticker symbol MFA. Let's review this stock and see if there's still tremendous upside or is it too late to get in. Quick profile about this company. It's an MFA Financial Incorporated is a holding company for its subsidiaries in the real estate finance business that invests in a portfolio of residential mortgage assets on a leveraged basis. This portfolio is primarily comprised of government-sponsored agency mortgage-backed securities, or MBS, non-agency MBS, residential mortgage loans, and credit risk transfers, or CRT, that divert risk from residential mortgages securitized by government-sponsored enterprises. Together, MBS and CRT securities represent the largest portion of MFA Financial's portfolio. The company generates nearly all of its revenue from interest payments derived from its financial holdings. The largest counterparties of MFA Financial's assets in terms of country of domicile are the US and Switzerland. As we hop into here, bar chart, you can see that MFA Financial's performance. You can see that on 3/24/20, it dropped all the way down to 32 cents. Since then, it's rose 481%, which is just crazy. We can see here from Yahoo Finance that MFA Financial normally hovers around $7. You can see it's $7.72 on December 23rd. Right now, it's at $1.86. So it looks like there's still a lot of opportunity to double or triple your money here. The dividend payout is listed at 47%, which is really high. The PE ratio is listed at 2.35. We'll dig into the fundamentals in just a sec. So you can see that the fundamentals here for MFA Financial look really good and really cheap right now. The price to book ratio is at 0.23. The trailing PE is at 2.15. Forward PE is at 2.19. So really cheap stock relative to the price. You can scroll down here. We can look at the other balance sheets with it. So this stock works primarily as it's entitled. It's a mortgage REIT stock, so it's based on leverage and interest paid. For example, you can see here another common mortgage REIT stock. That's one of the bigger ones. You see market cap's at $7 billion for this one. This one's held up pretty well, and it's because it consists of mostly government-backed mortgages. So you're probably wondering, what's going on in this market sector? Why is mortgage REITs getting pummeled so hard? I found an interesting clip here from CNBC that I wanted to share with you, and then we can discuss about what's going on.
Yeah, so Tom Barrack's warning is about those mortgage REITs in large part because many of these mortgage REITs have seen a huge amount of distress. I want to call your attention to two in particular. One is the Invesco Mortgage Capital Real Estate Investment Trust, and the other is the New York Mortgage Trust. Both of those in just the last month have lost around 80% of their value, and that's only because they're bouncing today off very distressed levels. The reason why they're distressed is because these mortgage-related REITs typically don't invest in real estate properties, they invest in mortgage bonds. And the reason they're in distress is because when mortgage bonds, commercial mortgage bonds, residential ones, loans of any kind of variety start to lose value, these funds actually buy them on margin. They borrow money to buy them. When those assets go down in value, margin calls happen. Can they meet those margin calls, or do they have to sell? And then if they sell, that pushes prices lower for all these mortgage bonds. Do other REITs have to sell? That's the reason why Tom Barrack is a little bit concerned about this. To put it a little bit differently now, there are large mortgage real estate investment trusts out there like Analysts Capital, AGNC, and Starwood Property Trust that have held up relatively better. And I would note this, Kelly, for AGNC, it's held up relatively well because it invests primarily in government-backed mortgages. So that's something to watch as well.
So it looks like what's going on, with all the uncertainty, with the market downturn, what's going on with, the outbreaks, looks like lenders and banks are, not being very accommodating when it comes to non-agency mortgage-backed loans. Anybody that's positioned with government-backed loans looks like they're a lot better off. The Federal Reserve is supporting agency mortgage-backed loans, so that should be helpful in a helping trend for the mortgage REITs. Looks like the banks as a whole are just making it very difficult for, the mortgage REIT companies because of how they're calling out the leveraging and the liquidity issues. But let's look into what some of these recent analysts have said about this company as a whole and see if it's still a good buy to get in. We can see here from a recent report on March 27 of 2020, MFA Financial Incorporated still has a rating of a 1 for a buy. Showing earnings strength as neutral, relative valuation very positive, price movement very positive. They project that MFA will strongly outperform the market over the next 6 to 12 months. This projection is based on our analysis of 3 factors that influence common stock performance: the earnings strength, the relative valuation, and recent price movement. You can see the commentary here, recommendation summary. Ford's strong buyer recommendation, MFA Financial Incorporated, is the result of systematic analysis of those 3 basic characteristics. The company has managed to produce a neutral trend in earnings per share over the past 5 quarters. While recent estimates for the company have been raised by analysts, MFA has posted better than expected results. Based on operating earnings yield, the company is undervalued when compared to all of the companies we've covered. Share price changes over the past year indicates that MFA will perform very well over the near term. In the last report we reviewed from the new constructs for MFA Financial Incorporated, this report was written on 3/26/2020. The current price at that point was 1.70. Dividend yield is currently at 47.1%. We can see here from their recommendations, they strongly recommend investors buy MFA. MFA earns our very attractive rating. A very attractive rating means this stock has superior upside potential with low downside risk. MFA ranks in the 99th percentile of the 2,850 plus stocks we cover. Ranks first out of 196 real estate sector stocks. You can see from the investment ratings details, the risk reward rating is at a very attractive. Economic versus reported EPS is rising. The return on capital is the second quintile. FCF yield is at greater than 10%. The price to EBV ratio less than 1.1. The growth appreciation period 0 to 3. Let's look at some quadrants. Economic earnings set at a very attractive. You can see here the description for that. The return on invested capital is set at attractive as well, so doing very strong. The free cash flow yield is at a 1 for very attractive. So overall, this stock looks really solid, even though it's been beat up. So just to wrap things up, based on my research for the stock that I've done, I do plan on investing in this stock. I have been buying this stock during the week. I did buy it at a low price point. I think there's a lot of upside potential, especially if it can return to its average price of around $7 to $8, which would, triple my investments. It's basically sustained for 10 years that price of $10 and has a very attractive dividend yield. You can see currently at 43% listed here. It just varies on where you're getting this information from. But even if it takes a while for it to come back, the dividend payout is still really attractive. I'll probably be building my position here just a little bit, buying on any dips. It's a really volatile thing, so you guys have to take it with a grain of salt of how you want to allocate your risk. It doesn't represent a big portion of my portfolio, but there's definitely some money in there that can, get some good upside out of it. So what do you guys think about the mortgage REITs as a stock play in the market? If you are interested in looking more into also M1 finance to, diversify your investing, it's all fractional based. So you can, depending on how much money you have, you can always chip in and, invest in stocks that look attractive to you. I left a link in the comment section or in the info section. It is an affiliate link, so we both get $10. Hope you guys liked the video. Give it a thumbs up. Hit the subscribe button to show your support. Thanks. See you all soon.